Okay, I think I think this is working. Um, Tonight, what we're going to do, I'm recording this right before your class, but this is Finance 334, and we're going to cover Chapter 9 tonight. But instead of actually meeting in person, I'm going to post this Tegrity recording, which will cover Chapter 9, and also there's a handout that we will use in next week's class that is labeled Chapter 7 from another book. So let me remind you for next week's class to be sure to bring a financial calculator if you have one. We're going to be using that some. But tonight I just wanted to go over some of the basics regarding mortgages and mortgage markets. So that's pretty simple. I'm leaving town. I'll be gone the rest of this week. I'll be gone next Monday, but I will be back on campus next Tuesday. So if you want to stop by and talk about, if we need to talk about scheduling classes, or anything like that, just set up an appointment with me. Also, let me remind you that next week, next Monday, Tuesday, Wednesday, and Thursday, is our Money Smart week. So we're going to be having programs at 4 o'clock every afternoon, Monday, Tuesday, Wednesday, and Thursday. That's the 3rd, 4th, 5th, and 6th. Monday, Wednesday, and Thursday, the program will be from 4 to 5 in the Mason Hall Auditorium, which is the nursing building. And on Tuesday afternoon at 4 o'clock, we're going to have the program in the main ballroom of the Curris Center. So we've got some really good door prizes, really good things we're giving away. I just found out this afternoon I'm going to have a couple of St. Louis Cardinals baseball tickets. They're for, I want to say they're for Monday, April 17th, although I really haven't checked that date. But we've got a couple tickets there. The face value of the tickets are $159 each. So there's some really good tickets for any of you St. Louis baseball fans who may be interested in that. But we'll be drawing for those every day. And then we're also giving away 2 $500 scholarships to undergraduate students. So for the scholarships, the more often you attend, the more programs you attend, the more chances you have in the drawing. Okay, but again, we can. If you have any questions, send me emails. I'll be able to get to my email this week, even though I won't be on campus. So just let me know. All right, so I'm going to bring up the presentation that we'll be looking at tonight. And like I said, this is chapter 9 from your textbook. And you can see that the title is Mortgage Markets. Now, what we're doing essentially, and I hope this is recording the right one. Let me just make sure. Okay, that didn't work out too well. Okay, here we go. All right. Okay, so the basics of mortgages. Now, from a banking class standpoint, of course, you need to understand mortgages, but just from an individual standpoint, you need to understand mortgages because most, if not all of you, are going to, at some point in your life, buy a house, and you're going to need to borrow money to buy that house. You know, most people do. Most people don't end up paying cash, at least for their first house. And so it gives a definition here. It says mortgages are loans to individuals or businesses to purchase a home, land, or other what's called real property. Okay, so essentially a real estate loan. And as we're going to talk about a little bit later, mortgages are often what's called securitized. The definition of securitization is simply when a mortgage is, or a group of mortgages are packaged and sold as assets backing a publicly traded or privately held debt instrument. Now, we'll get more into that in just a few minutes, but essentially, during the financial crisis of 2008, let me put this on pause for just a minute and I will be right back. All right, sorry about that interruption. Now, as I said, we're going to, a little bit later, we're going to talk about securitization and how securitization helped cause some of the financial meltdown or the financial crisis of 2008. Because essentially what this is referring to is mortgages. When a home loan is made, a lot of banks, instead of keeping them on their balance sheet, they will sell those mortgages. And there were purchases of mortgages such as Fannie Mae, Freddie Mac, and others, Ginnie Mae. And what they were doing, they would basically, through financial engineering, they would, how should I put this? They would take the mortgages, they would chop them up, they would create some type of debt instrument or bond that was backed by the mortgage, and then sell it to investors. And the way this worked is when a person made their house payment, then that house payment was passed through as income, either interest income or payback of the principal, to the people who owned the bonds that were backed by the mortgages. And it works great as long as everybody makes their house payment. But when people start missing house payments, then when they start defaulting on their home loans, then it creates a problem. And again, it's not a big problem as long as just a few people do that. But what we had was sort of in 2008, 2007, we had sort of a perfect storm where you had a lot of people who were defaulting on the mortgages. You had a lot of mortgages or homes whose value was decreasing by 40, 50, 60, 70%. And that caused not only the banks to be in trouble, or the lenders to be in trouble, but also the investments that had been purchased by banks that were backed by mortgage securities, that caused those to go into default also. So you had a lot of mortgage loans that were worthless. You had a lot of investments backed by mortgage loans that were worthless. And it can get pretty complicated. Now, in this chapter, I'm going to try to keep it as basic as possible, but this can get really, really, really complicated. Now, I did want to point out one thing to you, if I can do this. If you go to your, let me go to your course homepage. If you go to your course homepage, which you should be able to see it here, and you work your way down the page, now these are going to be the slides that I'm using, Chapter 9 PowerPoint. But if you work your way down to where it says miscellaneous articles, videos, etc., let's see, where is this? Okay. I actually just saw it, but maybe. Okay, here it is. If you, on the home page, if you work your way down to miscellaneous articles, and then click on the mortgage loans and secondary market link, which is right here. Now, what I'm going to give you next week is going to be a combination of these three links here. Okay, I've already got that ready. I've already got it copied and everything, so don't worry about printing this out or anything. I'll bring it to you next week in class. But if you click on this, mortgage loans in the secondary market, there's a ton of information here. There's some of the information that I discussed earlier. There's some examples. There's some practice problems. And then there's 3 videos here that are with, say, the Khan Academy videos. And it sort of, at least tries to, in a simple format, explain what's called mortgage-backed securities. And we'll talk about mortgage-backed securities in just a few minutes. But as the name implies, these are securities or investments that are backed by mortgages. Now, typically they're home mortgages, 1 to 4 family residence, but it could be any type of mortgage. So you can see there's 3 different videos here. You can watch these. They're pretty quick, pretty short videos, but it might help to understand some of what we're talking about. And again, we can touch upon that next week also. But I did want to bring that to your attention. All right, so back to and let me get this showing on this screen. Okay. So there are four basic categories of mortgages that are issued, and you can see these. Now this is kind of an old. I mean, I haven't updated this, but the reason is it's basically the same now as it was in 2010. You've got 1 to 4 family mortgages, which make up this big green area. You've got commercial mortgages, so these are mortgage loans made to businesses. You have multifamily mortgages, so this would be for an apartment building or some type of building that would house more than 4 families. And then you've got this small yellow slice here. These are farm mortgages, so to purchase farmland. And as we look at mortgages and think about mortgages, and it's something that is discussed a lot, it's something that tends to be a little confusing to the average person. I mean, I have almost, not every week, but almost every other week, somebody call me and they're wanting to borrow money to buy a house. They've gone to their local lender and they've been presented with several different types of mortgage loans. And I mean, these are smart people. These are really, really intelligent people, but they're overwhelmed with the choices that they have in terms of mortgage loans. Do I need a fixed rate mortgage? Do I need an adjustable rate mortgage? Do I need to pay points? Do I not need to pay points? If I need to pay points, how many points should I pay? And we'll discuss most of that in this chapter as we go through. Now, one thing that is really helpful is when we talk about mortgage characteristics, there's some terminology here that just helps you understand the process. So, for example, we've got collateral. And collateral, just like with any other loan, is the piece of property that secures the loan. So the way it works is you buy a house, the house and the real estate that goes with the house serves as collateral for the loan. If you stop making payments on the loan, the lender will foreclose on your piece of property. They'll take it back and they will sell it to gain back some, or hopefully for them, all of what they loaned you. Now, as this, this can be different in different areas, but the basic way this works is pretty simple and pretty standard. It says a lien is placed against the property, and a lien is a public record attached to the title of the property, giving the financial institution the right to sell the property if it is in default. And so the way this works is the lien is typically placed, is filed at the courthouse in the county in which the property is located. So, for example, if you buy a house here in Murray, then a lien would be filed at the Callaway County Courthouse. And this is public information. I mean, you can go down to the Callaway County Courthouse and you can just spend hours looking through the mortgage documents, determining, who owns what piece of property. So that's a fairly common thing that attorneys do. For example, if you're buying a piece of property, then an attorney may perform what's called a title search for you, which basically goes back and takes a look at the transfer of the title of the property to make sure that there are no outstanding liens against that property. Because the last thing you want to do is buy a house and think it's free and clear other than the mortgage that you're taking out to pay for the property, and finding out later that somebody else had placed a lien against the property that wasn't paid off, and it takes a first position to your mortgage. So if you're the lender, you're not very happy about that. So title searches are fairly common when it comes to purchasing property. You've got a down payment mentioned here. A down payment is simply the portion of the purchase price paid upfront by the borrower. Down payments do a couple of different things. The main reason for a down payment is it decreases the chance of what's called a walkaway. A walkaway is simply when a customer buys a house, they borrow money to purchase that house, and then for whatever reason, they decide they don't want the house any longer. And instead of trying to sell it and get some of their owner's equity out of the property, they simply walk away from the property. And this was a big problem back in 2007, 2008, 2009, when, let's say you bought a house a year ago, you paid $200,000 for the house, you borrowed $200,000, so you didn't have any down payment. The bank loaned you $200,000, and a year later, the house is only worth $100,000 because of the decrease in property values. So you've borrowed $200,000 against a house that's worth $100,000. Who knows how long it's going to take for it to get back up to be worth $100,000? And so you simply decide it's not worth it to me. I'm just going to leave the keys on the kitchen counter, and I'm going to pack up my stuff and drive away from the house and let the bank worry about it. That's what's called a walkaway. And also, when you have a down payment, if you have less than a 20% down payment, typically what's called PMI, or private mortgage insurance, is required for this property. And the private mortgage insurance just insures the difference between what you pay down and the 20% down payment. But it's required most of the time. It can be pretty expensive for the amount of insurance coverage that you're receiving. But a lot of times there may not be a way around it. You can get creative if you have good enough credit, and you might, for example, let's say you've got a 10% down payment, but you don't have 20%. Well, what you might be able to get there is a 90-10 loan, an 80-10 loan, which means you're going to finance 80% of the purchase price with a traditional mortgage, and then the 10% that you need to make up the rest of your down payment, you may finance that on some type of shorter term mortgage loan. The benefit of that is, even though you're going to pay a little bit higher interest on the second loan, the loan that covers the 10%, at least you're going to be paying on your mortgage, and you're not paying private mortgage insurance, which doesn't help you pay off the loan. It just is a benefit to the lender. And that if you do have private mortgage insurance, it's typically going to be in place until your home or your property reaches 80% loan to value. And at that point, it should drop off. Okay. And I will tell you that there have been cases where, unless the customer calls the lender and asks them to take off the private mortgage insurance, sometimes they will leave it on there for sometimes up to a year or two, and keep collecting it, because it's a pretty good moneymaker for the insurance company and for the lenders. Now, when it comes to mortgages, there's a couple of different types. One's called an insured mortgage. This is where the repayment of the mortgage is guaranteed by the FHA, which is the Federal Housing Authority, or the VA, which is the Veterans Administration, for a small fee. And then there's what's called a conventional mortgage, where the repayment is not guaranteed. I will tell you, most mortgages fall under the conventional mortgage category, which means there's no guarantee that it's going to be repaid. And the maturities of mortgages, typically it's going to be anywhere from 15 to 30 years. But I mean, you can get a 10-year mortgage, you can get a 15-year mortgage, 20, 25, 30, even a 40-year mortgage in some parts of the country. And some mortgages have balloons, a balloon payment. So you may have a mortgage with a 3-year balloon or a 5-year balloon. What that means is, let's say you get a mortgage with a 3-year balloon. You borrow, I'm just going to make up the number, $100,000. What happens is, you would amortize that $100,000 over, let's say, a 30-year period. So your payment's based on a 30-year mortgage. But some banks, because they can't, I mean, just financially, because of the setup of their balance sheet, they can't make you a 30-year fixed rate mortgage. But what they can do is they can promise you a fixed rate for, say, the first 3 years. And after the 3 years is up, you're going to have a balloon payment, which is the balance of the mortgage that you either have to pay off or refinance at current market interest rates. So if you get a 3-year balloon loan, you might amortize it over 30 years. You make your payment for 3 years, and then at the end of the 3-year period, whatever the balance is, you refinance that, preferably for 27 years, because you've already taken 3 years of the 30-year mortgage. And you might take out another 3-year balloon 3 years later, you refinance it for the next 24 years, and so on and so forth. So what this does, this helps lenders minimize their interest rate risk associated with your mortgage, even though most people prefer at least these days, a fixed rate mortgage, whether it's 15 years or 30 years. Now, as I mentioned earlier, interest rates on mortgages can be fixed or variable. With a fixed rate mortgage, as the name implies, the interest rate doesn't change over the life of the mortgage. It's pretty simple. It's pretty straightforward. Whatever you're paying in interest now is what you're going to pay. If it's a 30-year fixed rate, you're going to pay it for the entire 30 years. Now, there are what's called adjustable rate mortgages, or they're also referred to as ARMs. And this is where the interest rate can adjust and is tied to an index with typically some type of annual and lifetime cap. So the way this works is, let me see if I can get this working here so you can see me. Right, okay, so let's say, for example, you have a, okay, see if it's right. Okay, so you have a 3-1 arm, and it has a 2-6. It's supposed to be an A, by the way. I'm looking at the screen and I'm writing about 3 feet to the right of the screen, so you just have to forgive how bad this is. Okay, so what this means is your 3-1 arm. This means that the interest rate is fixed for 3 years, and it can adjust every 1 year after the first 3. So that's what the 3-1 arm represents. And you can have a 5-1 arm, which means it's fixed for the first 5 years and then it adjusts every year afterwards. Whatever, there's lots of different adjustable rate mortgages out there. Now, the cap, the way the cap works, so you've got on this loan, you've got a 2.6 cap. What that means is that the loan can adjust, because remember, this is tied to an index. So the index may increase or decrease, which means the interest rate you're paying is going to increase or decrease. So the 2 represents the change over 1 adjustment period, and the 6 represents the lifetime cap on the loan in terms of interest rate changes. So for example, let's say you took out a 3-1 arm and you took it out at 5%. So initially, based on your index, you're paying a 5% interest rate. After 3 years is up, then now again, you can set these up different ways, okay? But this is what I'm just describing here. After 3 years, your loan could adjust. If the index increases by 200 basis points or 2 percentage points, it could increase up to 2%. So if that's the case, you would now be paying a 7% interest rate, which means you're going to have an increased payment. Your payment is going to go up. And every year after that, with your 3-1 ARM, so the rate can adjust every year, it can adjust 2% up or down each year up to a maximum of 6%. So what this means is that, at least theoretically, your interest rate on your loan could climb to 11%, or it's not going to be negative, so at least theoretically you could go to 0%. Okay, it could go down to 6%, but since it's not going to be negative, you could go to a 0% interest rate. Typically, we're not worried. I mean, this would be fantastic if our rates go down. The problem is, over the next few years, I've got a feeling you're going to see rates going up. So adjustable rate mortgages are a little bit riskier. The reason people like them is a lot of times they come with what's called a teaser rate. A teaser rate simply means it's a really low rate of interest initially, which means your house payment is low and it's very affordable. But then once it starts adjusting, a lot of times the payment gets out of the control of the borrower, and it gets to the point where the borrower simply can't make their home payment or their house payment any longer. So that's something you just need to be aware of. But that's how ARMs work, and that's how the caps work on ARMs. All right. Okay. Points, discount points. This may be probably the most confusing thing for the average borrower. And it's really not that complicated. It's just people have always heard how difficult points are to understand. Well, points aren't difficult. All points are, it says fees, points are fees paid up front to buy down the interest rate on the loan. So essentially, points are simply prepaid interest. So the more points you pay, the lower your interest rate on your home loan will be. And 1 point is equal to 1% of the principal value of the mortgage. So 1 point is equal to 1% of the loan amount. And the more points you pay, the lower your interest rate. But the big question is, for most people, is, where do you stop with this? Because, we could pay 2 points, 3 points, 5 points. You could keep paying interest, but where does it stop being advantageous to you as a borrower? So we'll kind of take a look at that and see how we can calculate this. And of course, an amortization schedule, you study this in Finance 330. An amortization schedule is simply a table showing for each payment, after each payment's made, how much is the remaining balance on the loan, how much of each payment goes to principal, and how much of each payment goes to interest. So, and again, I think most of you are fairly familiar with an amortization schedule. And then there's other types of mortgages. There's lots of different ways that you can finance real estate. You've got some listed here: automatic rate reduction mortgages, graduated payment mortgages, growing equity mortgages, a second mortgage, home equity loans, shared appreciation mortgage, equity participation, reverse annuity. There's lots and lots of different types of mortgages. Now, we're just going to kind of talk about some of the basic items here, but it can get a lot more complicated. All right, let's see. Let me see if I'm going to... Okay, we can talk about this for just a minute. This is talking about an amortized loan. You studied this in Finance 330, and what you learned was that an amortized loan is a loan that is repaid in equal payments over its lifetime. The payments can cover just about any time period. They can be annual payments, they can be quarterly payments. Typically, they're monthly payments. So if we're talking about a car loan or a home loan, normally your payment is due each month. And of the total loan payment, a portion of that goes to interest, which is what you're paying the lender to use their money. And a portion of that goes to principal, which is the amount that you originally borrowed. And so with each payment, what happens is a little more of your total payment goes to principal, a little less of your total payment goes to interest. And an amortization table will show you this. You can look at it even for a 30-year fixed rate mortgage, which if it's a monthly payment, that's going to be 30 times 12. That's 360 lines on the amortization schedule showing what happens with each individual payment. Now you can see an example of an amortization schedule here. This is for a pretty simple loan. This is a $15,000 loan. It has annual payments, so one payment per year, and the interest rate is 8%. So we can see here, for example, the first year. Now the total payment on this loan, and we could calculate this using our financial calculator, the total payment is $5,820.50 per year. But you'll notice of the total payment is broken down into an interest portion and it's broken down into a principal portion. So the first year, $1,200 goes to interest and $4,620.50 goes to principal. And of course, if you add these two up, it's going to equal the total payment. If we take the payment minus what we paid on the principal, it gives us the balance that we still owe on the loan. And then we take this number, we take it to year 2, the payment stays the same. Of the total payment, $58.20, $830 goes to interest, $49.90 goes to principal. So you can see more goes to principal, less goes to interest, and you've got the remaining balance. And then for the third payment, you've got it broken down into what goes to interest, what goes to principal, and then the balance is zero. It's off a little bit here due to rounding. Now, with your financial calculator, you've got an amortization schedule, and you can calculate a loan payment. And I'll show you this in just a minute. Now, we're going to calculate a loan payment. So if you've got your financial calculator, you're going to want to have it set to 12 payments per year. And we'll go through an example of how do you calculate a loan payment, how do you access the amortization schedule. So if we take a look at the inputs for our financial calculator, you can see that we need 3 inputs and we solve for the 4th. So for example, the amount that you borrow, the principal amount, that's called the present value. The interest rate is going to be the I/Y on your financial calculator, and the number of loan payments is going to be the N on the financial calculator. And we're going to solve for the PMT, or the payment amount. And as I mentioned earlier, if it's a monthly payment loan, your calculator should be on 12 payments per year. And to get to that point, you would press the second key and then the I/Y key. You would put in the number 12 and then press the enter key. So let me show you this, if I can get it to show up on the screen. Okay, so here is my financial calculator. And you can see if I press the second key, and then what I want to access is the P/Y, the payments per year. So that's right above the I/Y key. So if I press the I/Y key, you can see mine is currently set to 1 payment per year. I want to change it to 12. So I'm just going to put in the number 12. Then it tells me at the top of the screen, press the enter key to lock it in. And then I'm going to press my clear button a couple of times in the bottom left-hand corner. And now if I want to go back and check, I can just press second I/Y, and it's set to 12 payments per year. And another thing that I want to do, and most of you are very familiar with your financial calculators, but I want to go through the clear process once I've done this and once I'm ready to work another problem. So to clear out any old inputs, I'm going to press the second key 1 time. And this says CLRTVM. That stands for Clear Time Value of Money. And then I'm going to press the second key again 1 time. And at the bottom left-hand corner, it says CLRWRK, Clear Work. So let's say I've worked a problem. I've cleared back to zeros. I want to clear out my old inputs, so I'll press second, Clear Time Value of Money, second, and Clear Work. And now I'm ready to work another problem. All right, so here is an example of a $150,000 home that we're purchasing. We're going to use a 30-year mortgage. The interest rate is 8%. They're 0 point, and we're paying 20% down. So these would be the inputs. That means if it's $150,000, 20% of 150 is $30,000 that we're paying down. So that means we're going to have to borrow $120,000. So that's our present value. Now, our N, even though we've changed our calculator to 12 payments per year, we have to multiply the number of years times 12. So N is going to be 30 times 12, which equals 360. So we just put in 360, press the N key, and then the interest rate, the I/Y, is simply 8%. Once those three variables are in, we want to press our compute key, press the payment key, and we should come up with a payment of $880.52. So let me bring up my financial calculator. Now remember, I changed to 12 payments per year. Okay, so I'm good to go there. I cleared everything out, but just out of habit, I'm going to go through again and clear it out. And now I'll enter the information. So 120,000, that is the PV. Press the present value key. 360 is the N, and 8 is the I/Y, interest per year. Now I want to compute, press the compute key in the top left-hand corner, the payment. And it shows me, well, here, that my payment is $880.52, which matches what I have here. So that's with a 30-year mortgage. Now, with a 15-year mortgage, we can do the same thing. $150,000 home, we're putting 20% down. We're financing it for 15 years times 12, or 180 monthly payments, and the interest rate is still 8%. So for this, I mean, we don't have to necessarily change everything. All we have to change is our variable, which is N. The only thing that's changed is the N. So if we put in 180 and press the N key, everything else stays the same, and we can compute the payment amount, which is $1,146.78 per month. So hopefully, as you're calculating these at home, hopefully you came up with these numbers. If you didn't, the first thing I would check is the payments per year. Make sure you're on 12 payments per year. The second thing I would do is be sure you're going through the clear process. Second, clear time value of money. Second, clear work. Now, once we've done this, we can access, once you've calculated any loan payment, you can access the amortization schedule. I'm not, well, let me bring this up so you can see it. I'm not going to teach from this slide, but I do want you to see what step by step how you use the amortization schedule. So that's what all of this writing is referring to. Okay, so don't look at this and go, wow, that's the worst PowerPoint slide I've ever seen, because he's done everything wrong. He's got too much writing, it's too small, and it's too complicated. I know all of that, okay? I'm just wanting you, if you're watching this at home, or if you happen to forget how to do this, then you can simply walk through it. It tells you which keys to press, okay? Now, based on this, for example, with the 30-year mortgage, I'm going to click out of this and bring my calculator back up. We can answer some of these questions. For example, it says for the 30-year mortgage, how much principal and interest along with the remaining balance is related to the first monthly payment, the second monthly payment, the first 12 payments, the first 180 payments, or all 360 payments. So we can do that, okay? So what I'm going to do is I'm going to get back to, I'm going to put in 360, press my N, and compute the payment. Okay, so I want to get back to the 30-year mortgage payment, which is what I have here. So it was $880.52 per month. Now, if you take a look at the previous slide. It's going to show you exactly how you do this. I'm just going to go ahead and walk you through it. The amortization schedule is here right above the present value key. It says AMORT. So if I press the second key and the present value key, what you're going to see is going to say P1, and if you press the down arrow key, it's going to say P2. Now, P stands for payment. So if we're interested in just a single payment, we would set P1 and P2 equal to that payment number, just the payment that we're interested in. So for example, in here it says, how much principal and interest goes, or how much is paid on principal and interest for the first monthly payment. So if we're interested in just payment number 1, we're going to set P1 equal to 1. If yours is not, you just press the number 1, press the enter key, and then we're going to press the down arrow key, and we're going to set P2 equal to 1. So 1, enter. Now if I press the down arrow key, I'm going to see the remaining balance after I've made the first payment. I'm going to see how much of the first payment went to principal. So $80.52 went to principal, and $800 went to interest. So you can see most of your first payment is going to interest because you're using a lot of the lender's money at this point. And the great thing about this is, see the up and down arrow keys here. That means you can move around within this function. You can't get lost, okay? I mean, you can just keep pressing the down arrow key. It's going to take you back to where you started. You can press the up arrow key, go around. I mean, it doesn't matter, okay? So you can just play with this. Now, the second part of this says how much principal and interest is related to the second payment. So we will know about just payment number 2. So to do that, I'm going to set P1 equal to 2, press the enter key, and I'm going to set P2 equal to 2 and press the enter key. Now if I press my down arrow key, after the second house payment's been made, I owe $119,838, and of my total payment amount, $81.05 goes to principal, and $799.46 goes to interest. Now, what I said earlier was, as you make your payments with an amortizing loan, more is going to go to principal, less is going to go to interest. So from this first payment to the second payment, it looks like 54 more cents went to principal and 54 cents less went to interest. So I wasn't lying to you. That is happening. But the problem is when you have a long-term loan like a 30-year mortgage, it's a very slow process. Because what you want to happen is, as somebody who's borrowing money, you want most of your payment to go to principal because paying down the principal pays down your loan. The problem is, again, with a 30-year mortgage, it takes a long time for that to happen. So you're paying a lot of interest on the 30-year mortgage. Now, the third part here says, what about the first 12 payments? How much principal and interest do I pay over the first 12 payments? Well, for a series of payments, what you want to do is you want to set P1 equal to the beginning of the series. You want to set P2 equal to the end of the series. So in this case, the beginning is payment 1. The end is payment 12. So I'm going to use my down arrow key to work my way back around to P1. I'm going to set P1 equal to 1, so 1 and then enter. Press my down arrow key, and I'm going to set P2 equal to 12 and then enter. Now if I press my down arrow key, it's going to show after the first 12 payments, I still owe on this house $118,997. I have paid a total after the first 12 payments of $1,002 on the principal, and I have paid $9,563 in interest. So that's just what I mentioned earlier. With a 30-year mortgage, your first, many payments at the beginning of the loan are going to go mostly to interest. And some people look at this and they think the lender is doing something illegal. Well, actually, they're not doing anything illegal. Just think about it for a minute, the way this works. when you first borrow the money, you have a lot of the lender's money. So you have to pay a lot of interest on all that money. But as you keep making your loan payments, you're paying down a portion, although maybe a small portion, but a portion of the principal. So that means you have less of their money, which means you pay less interest. But it goes down so slowly that people look at this and they think there must be something illegal happening. Well, nothing's illegal is happening here. It's just, that's just the nature of a 30-year mortgage. We can look here at the first 180 payments. So if we set P1 equal to 1, if we set P2 equal to 180, then you're going to see after the first 180 payments have been made, you still owe $92,137. You've paid a total of $27,862 on the principal, and you have paid $130,631 in interest. Now, this goes back to understanding time value of money, because a lot of people think that, you know, if I've paid on this loan for, if it's a 30-year mortgage and I've paid on it for 15 years, I must have half of the loan paid for. Well, again, because of time value of money and the exponential function, that's not happening. You borrowed 120, half of it would be 60, but after 30 years of paying on this mortgage, you still owe 92,137. And we could look at the entire mortgage if you wanted to. So we could set P1 equal to 1. We could set P2 equal to 360. And you can see that after we made our 360 payments, the balance is going to be 0 or close to it, a little bit off due to rounding. The principal, we paid back the entire $120,000 that we borrowed, and we've paid $196,986 in interest. So that 30-year mortgage cost us a lot of interest. But again, that's just sort of the nature of a home mortgage. Now, you could do the same calculations, it says here, do the same calculations for a 15-year mortgage, and what you're going to see is the 15-year mortgage. So let me jump back there really quickly. So let me go to my in. We'll see if this will work. It may not work. 180 in compute payment. No, it's not going to. Okay. Let me get back there really quickly. So it was 120,000. Present value 8 interest per year. 180 is my N. That's 15 years times 12. Compute payment. Okay, so there's my payment amount. Now you'll notice that the payment amount here is more because it's a 15-year mortgage versus a 30-year mortgage. It's more expensive. I mean, that's true. I mean, it has to be. So it's $1,146 versus $880. So we've got, let's see, it's $266 more per month. Let's see, 880, 1080, 1146. Yeah, okay, so $246 more per month. It's not twice as much, but it is more. So in looking at this, now this is back with showing the 15-year mortgage. We could go to the amortization schedule and we could take a look at what's the total cost. Okay, so we can set P1 equal to 1, we set P2 equal to 180. Press the enter key. Now we can press our down arrow key. The balance after making 15 years worth of payments, we're paying a little more per month. The house is paid off. Now remember, this is the same house, okay? There's nothing different about this house. It has the same driveway, the same number of bedrooms, the same square footage, the same shrubbery, the same everything. It's just that we're financing the house. In one example, using a 30-year mortgage. We're financing the house in another example using a 15-year mortgage. And so after 15 years with the 15-year mortgage, the house is paid for. We've paid $120,000 in principal, and we've paid $86,420 in interest. Now remember, the last one we paid like what, $196,000 in interest. So you're saving yourself about $110,000 in interest by financing the same house with a 15-year mortgage versus a 30-year mortgage. But again, it kind of comes down to what can you afford. I mean, sometimes the extra money is just not there for the 15-year mortgage, so you have to take out a 30-year mortgage. Although I would suggest that if it would meet your needs, buying a house that you could pay for with a 15-year mortgage financially would be a much, much smarter move, especially as interest rates start going up. Because if we're down at historical low interest rates of 30-year fixed rate loans at 3.5%, there's not really a big difference there because interest is so cheap. But if you're getting up into the 7%, 8%, 9% historical averages for mortgage interest rates, you can save yourself a lot of money by financing for 15 years instead of 30 years. Now, the question here at the bottom of the slide says, what do you do if you can't afford a 15-year mortgage, but you want to pay for your house in less than 30 years? Well, the thing is, what you can do is you could take out a 30-year mortgage, but calculate what would the payment be on a 15-year mortgage. So it's going to be higher. So each month you make your regular 30-year mortgage payment, and then you pay the difference between the 30 and the 15-year mortgage. You pay that on principal, the principal of the loan. So what that means is if you did this every month, your house, even though you took out a 30-year mortgage, your house would be paid for in 15 years. But the great thing about this is, if let's say you have a job where your income is not necessarily stable, so maybe you're paid on commission, for example. If one month you have a really bad month financially, all you have to do is make your 30-year mortgage payment, your regular payment, and you don't have to pay the additional money on principal. But then the next month, if things get better, you can start paying the additional principal, and you're still going to have your house paid off well in advance, even if you happen to miss, a month every now and then without paying the additional principal. It's still going to make a really, really big difference. All right, so this example, I'm going to save this for next week in class, the points versus no points example. That's why I want you to be sure to bring your financial calculator to class with you. Okay, so we'll come back to this. I want to talk for just a few minutes about the secondary mortgage market. Okay, now the way this works is typically when a lender makes a loan, they've got a couple of options. One is they can keep the loan what they call in-house, which means they keep it on their balance sheet, and they're going to collect the payments for it. They're going to service the loan. If anybody has questions, they come in and ask you about it. I mean, that's called an in-house loan. But the other type is what's called a secondary market loan. So this is a loan that your local bank or your local lender may make this loan, but then they're going to sell it, or they're going to securitize it, which is what we talked about at the very beginning of these slides. So if a financial institution or a bank wants to securitize mortgages, there are some advantages to this. For example, the first one listed here says it reduces the liquidity risk, the interest rate risk, and the credit risk of the financial institution's portfolio. And that's because you're getting that loan off of your balance sheet. You're selling it, you're getting the cash for it. Now you can make other loans with that cash. Also, it says the financial institution retains income from origination fees and service fees and offsets regulatory constraints. So if you make a mortgage loan at your bank, but you're going to sell it, you still get a little bit of money in terms of origination fees. Maybe if you collect the payments each month, even though you don't sell on the loan, you might receive some servicing fees. And it also helps with some of the regulatory constraints that you may face as a lender. When a mortgage is sold, it can be sold with recourse or without recourse. Okay, so you need to know this on the next test. Okay, that's why it's in bright red here. If a mortgage loan is sold with recourse, what that means is that if the loan goes bad, that you can sell it back. If you're the purchaser, you can sell that loan back to the originator. You can simply say, hey, look, no, they stopped paying on this loan. I want you to buy it back. And the originator has to purchase the loan back. Okay, most loans are not sold with recourse. Most loans are sold without recourse. What that means is if you're buying this loan, you need to do your own check of the credit worthiness of the borrower, because you're now buying their loan. They're going to be making their loan payments probably to you, and you want to make sure that they're going to be able to make those loan payments and make them on time. Because when you sell a loan without recourse, that means that the originator has no further liability once this loan is sold. You're simply saying to the seller, okay, it's your loan now, you deal with it. Now, just some terminology here, and you hear this, some of these terms thrown around a lot. You know, for example, what's called the Federal National Mortgage Association, or Fannie Mae, FNMA. This was created during the Great Depression. So this was to help out with home ownership during the Great Depression. You've got the FHA and VA. So you've got, we talked about this a little bit earlier, so you've got insured loans created during this time. You've got the Government National Mortgage Association, or it's pronounced or abbreviated Ginnie Mae, or the Federal Home Loan Mortgage Corporation, which is a lot of times simply referred to as Freddie Mac. These were created during the 1960s. And over the last 20 to 25 years, I mean, there's been a huge, how should I put this, a huge financial engineering boom, where a lot of different mortgage-backed securities have been created over the last 20 to 25 years. And so now you've got access in excess of 50% of mortgages now are securitized. So your local bank may make your mortgage loan. You may deal with a loan officer who you know, but then they're going to sell it. And the way it works is probably around 6 weeks, a month to 6 weeks after you get your home loan, you're going to get a letter in the mail saying that it's been sold to a bank in California, or to a bank in Texas, or a bank in Connecticut or Delaware, or wherever it might be. So that's, I mean, that's fairly common, and it's not unusual for your loan to be sold more than once. So during the life of the loan, you may be making payments to 2 or 3 or 4 or 5 different lenders, depending on how often your loan is sold. Now, let's talk about, we're talking about securitization, but let's kind of differentiate between what's called a mortgage sale, that's selling a mortgage, and securitizing a mortgage. Because a mortgage sale is different than securitization. A mortgage sale allows financial institutions to, 1, manage credit risk, 2, achieve better asset diversification, and 3, improves their liquidity risk. So some of the benefits are the same as securitization. So it says financial institutions are encouraged to sell loans for economic and regulatory reasons. And major buyers of mortgage loans, Fannie Mae, Freddie Mac, and major sellers of mortgage loans, money center banks, small banks, etc. Now, as long as you understand there's a difference between selling a loan and securitizing a loan, let's talk about securitization. And again, I'm trying to simplify this as much as possible, but these are the 3 major forms of mortgage securitization. And again, there's lots of other ones out there. That's why I mentioned, if you watch the videos that I pointed out earlier, that's on the Canvas homepage, you may get a better understanding, I hope, of sort of how this process works. So there's three major forms here. You've got pass-through securities, you have collateralized mortgage obligations or CMOs, and you have mortgage-backed bonds. We're going to talk about each one of these. So the first one, pass-through securities. So just as the name implies, it says these are mortgages backed by securities that pass through promised payments of principal and interest on pools of mortgages to security holders. So that's what I mentioned earlier. When somebody makes their house payment, that house payment is passed through to the owners of these pass-through mortgage securities. So some is in the form of principal, some will be in the form of interest, some might be in a combination of principal and interest. These are typically issued in standard denominations of $25,000 with increments of $5,000 beyond the minimum, and through government-owned or sponsored agencies involved, Ginnie Mae, Fannie Mae, and Freddie Mac. So this is an investment. So these pass-through securities. So banks buy a lot of these. Private investors buy a lot of these. I mean, it's just another type of investment. Now, the second one here was called a CMO, or a collateralized mortgage obligation. This is a mortgage-backed bond issued in multiple classes, or what's called a tranche. Okay, so this is a French word, and I'm not very good at speaking French. But you can see a tranche here. A tranche is a bondholder class associated with a CMO. So you have, through financial engineering, you have these mortgages that are used to back bonds, and the bonds are put into different tranches based on their risk. So you might have a bond in a first tranche that's not very risky, but you may have the same batch of mortgages split into, let's say, 5 different tranches, whereas a bond that's in the 5th tranche would be a pretty risky investment. Because what's typically going to happen is the money is going to go through to the first class of tranches, then what's left over is going to go to the second class, and then it's going to go to the third class, and the fourth class, and the fifth class. Now, to compensate investors for this increased risk, the bonds in the lower class tranches, such as maybe 4 or 5 or whatever, but you can have as many as you can create, they're going to have a higher yield, but of course they're much riskier. So it depends on the investor as to what tranche bond they want to invest in. So it says here it's created by packaging and securitizing whole mortgage loans or re-securitizing pass-through securities, and it's attractive to secondary mortgage market investors because they can choose a particular CMO class that fits their maturity needs, and that goes back to the tranches here. Okay, so you may have one tranche that matures in 3 years. You may have another one that matures in 5 years, another one that matures in 10 years. So again, it's just, up to the investor. And the really important thing to take away from this is, as an investor, whether you're a bank, whether you're an individual, as an investor in something like a CMO, it's really, really important to understand, how does this work? How does this investment work? As an investor, how do I get my money from this investment? And if it's so complicated that you can't understand it, you really don't need to invest in it. And that's what happened to a lot of investors back during the financial crisis, when they were investing in all of these CMOs and other types of pretty sophisticated financially engineered products. And it sounded good, but the investors didn't have the expertise or the knowledge to invest in these items because they didn't really understand how they worked. But they just, the bond salesman who called them said, hey, we've got a great investment here. It's a really safe investment. It's got a rating. This is where bond rating is going to come in, and the the accuracy of bond ratings. It's a single A rated bond, so it's investment grade. It's going to be fine. Well, it wasn't necessarily fine, and you had a lot of people losing literally billions of dollars because of this. So again, it's something that you need to be aware of and be careful of. Now, when it comes to collateralized mortgage obligations, there's a type with something called a strip, and it says some mortgage obligations are issued in strips, and you can have a couple different types of strips. One's called an interest-only strip, and this is where the interest portion of a mortgage payment, so the interest portion of your house payment, it flows through to the strip holder. So they're just collecting the interest portion of the mortgage payment. And it says here at the bottom, pretty important, it says if interest rates drop extremely fast, the security holder may not receive their initial investment because mortgages securing the interest-only strip are refinanced. So what this is saying is, when interest rates go down, people tend to go in and refinance their mortgage. So they want to refinance it at a lower interest rate. So if you have bought an interest-only strip and the cash flows for this interest-only strip are based on all the interest payments coming in, or most of the interest payments flowing in, if interest rates go down pretty fast, and a lot of the people whose mortgages, their interest payments were flowing through to this interest-only strip, if they refinance that mortgage with another mortgage, the interest payments disappear. I mean, if you pay off one mortgage with another mortgage, the interest payments on the first mortgage, they're gone. You don't make the future interest payments on that first mortgage because now you're paying it off with the next mortgage. So this can be a really risky investment depending on which direction interest rates are moving. Now, you also have strips called principal-only strips, and this is where the principal portion of the mortgage payments flow through to the security holder. So remember, interest-only strips, that was the interest portion of the mortgage payment. Principal-only strips, the principal portion, that's paying down the amount that was borrowed. And so it says here at the bottom, principal-only strip holders, they want interest rates to decline so that they can recover their investment sooner because of refinancing. Because when a mortgage is refinanced, the principal is always paid off at a refinance. But as I mentioned earlier, the future interest payments are gone forever. So if you refinance a mortgage, you go in, you pay off the principal. So that's fine for the principal-only strip holders. They're happy with that. But you pay off the principal, you now have a new mortgage with new interest payments, and those former interest payments, those have disappeared forever. I mean, they're not coming back. And then also you've got something called a mortgage-backed bond. And a mortgage-backed bond, it's a little different than the first two we've talked about because it's a bond that is secured by a pool of assets. But as you can see here, it says that mortgage-backed bonds differ from pass-through securities and CMOs or collateralized mortgage obligations in two different ways. And one of them is that they normally remain on the balance sheet of the financial institution. So the mortgage-backed bond stays there, it's not sold. And secondly, the cash flows are not necessarily directly connected to the interest and principal payments of the mortgage-backed bond. So this is a bond secured by a pool of assets, but the interest and principal payments made on the mortgages aren't necessarily the cash flows that are going to the mortgage-backed bond holders. The cash flows can come from other areas. So you need to know these three different types, okay, as we talked about for the next test. So they're listed here, pass-through securities, CMOs, and mortgage-backed bonds. And then under CMOs, know what strips are, know what an interest-only strip is, a principal-only strip, and what's going to happen if interest rates go down. Interest-only strip holders don't want interest rates to go down fast, whereas principal-only strip holders, they don't mind interest rates decreasing quickly. And then finally, there's going to be some additional material. Like I said, I'm going to bring that to class next week and pass it out. We will go through some examples of whether to pay points or whether not to pay points, and we'll look at some of those. So be sure to bring your financial calculator to class. As I said, I'm going to be out of town for the rest of the week, through the weekend and on Monday. So if anybody has any questions or issues, feel free to email me and I'll try to get back to you as soon as possible. But otherwise, I'm going to post this video to Canvas. It should be ready in about 10 minutes. Remember, we're not having class tonight. This is taking the place of our class, but I will see all of you next Tuesday night. And by the way, try to get the word out about the financial literacy programs next week. Monday, Tuesday, Wednesday, Thursday afternoon. Tell your friends, tell your fraternity members, your sorority sisters, your residential college members, I mean, whoever, get the word out, because we would like a lot of students participating. One, because it's important to know this stuff, but secondly, we've got a lot of good things we're giving away. So if you're like I was when I was a college student, free stuff is always good. So everybody have a great week, have a safe week, and I will see you in class next Tuesday night.